Right folks, welcome back to the channel. Here we have the Dow Jones in front of us on the US 30 daily time frame in front of us, and we're going to be going over just a basic price action review as to how I'm looking at this market and where I think it's going to head to next. So of course here we have our bullish structure already highlighted, right? So from the last video we looked at the four pillars. We understand now we have a structural low down here and we have our structural high just over here. So this here is our dealing range, right? So our dealing range again consists of a high and a low, right? Or should I say a low up to a high. So this particular application of the Fibonacci tool allows us to distinguish very clearly where the premium and discount arrays are. So we have a discount down here and a premium up here. So again, we had our daily POI over here. So just to quickly bring that to people's attention, we had a very clear fair value gap here, which I've marked out in blue. And now from here, this fair value gap of course gives rise to a POI. Now the POI is the last candle prior to the largest imbalance candle, right? So this now becomes our daily POI. Hence why I label that daily POI. So it's no secret that prices reacted and bounced off this particular level. Notice how prices come in, simply the wicks have come in, filled all of the inefficiencies over here before heading higher. And so from here, we need to understand where is price likely to target next. Well, price moves up for two reasons, right? Price moves up for two reasons. According to the interbank price delivery algorithm, price will move up for two reasons. Now, the first reason is simply to target liquidity. And the second reason will be to fill inefficiencies or fair value gaps, right? These are the two driving factors as to why the market will move up or move down. So first we saw price head down. So April was quite bearish for the Dow Jones. April the 1st up until around April the 19th. So the majority of April was bearish. And so the reason for that, looking back in hindsight, so we can use hindsight to understand the concepts which we trade anyway and then apply them to the future, right? Apply them to price action in the future, building a bias. And here's how we do it. So what we had over here is we had sell side liquidity over here in the form of this large trend line over here. This here is sell side liquidity, and this here is a buy side inefficiency where the POI is. And so from here, when price does move down, what we see over here is we see price heading lower, sweeping the liquidity and mitigating this POI here, filling in the fair value gap just over here before heading higher. And so from here, we understand that the price action here was simply to move down, to sweep liquidity and to fill the inefficiency. So from here, we apply the same overall logic in the market. So from here, we understand that we haven't got a huge amount of liquidity over here to really deal with. Well, on the 4-hour time frame, we will, and we're going to be going down to the 4-hour time frame. But really, we have a fair value gap just over here. So this is an inefficiency over here, and this gives rise to a POI. So this candle over here left an imbalance, and so this now becomes the daily POI, or the daily inefficiency. And so again, this is the point of interest, which I think is going to get mitigated in the near future. So this price point here is at 39,718 or 39,718.4. So from here, that I expect price to reach this zone in the upcoming days and weeks. So that's a quick overall bias as to how you could trade the Dow Jones or the US 30. So now if we head down to the 4-hour time frame, we can begin to dissect the price action in some more detail. So again, what we had, of course, as we're coming down to the daily zone, right, the daily POI, we're going to have bearish structure just like this, right? We have highs and lows and highs over here and lows and highs and lows. So from here, we've had two breaks of structure to the downside. So we've had a high form and we've had another high. So we've confirmed ourselves to be bullish in terms of our overall structure. Now we understand we had a bullish POI over here, or a bullish fair value gap over here, right? So we didn't have the entire fair value gap filled, right? But we understand the majority of that fair value gap has been filled. So from backtesting that I've done, from data gathering and backtesting, we understand that the majority of this fair value gap has been filled, and we've seen price break structure to the upside. So this here gives indication for higher prices. So notice how we have a daily bias, which is to aim for this POI up here. And we have the fact that we've broken structure to the upside and buy side inefficiency has been filled and respected. And so from here, we understand that IPTA, again, we're highlighting the key aspects of IPTA over here. IPTA moves up for two reasons, right? IPTA will look to seek liquidity and IPTA will look to rebalance fair value gaps. So these are the two driving factors to the market. So whenever you're determining a bias, you have to keep these two things in mind. Where are the liquidity pools and where are the fair value gaps? And this is what price is going to gravitate towards all the time. And so from here, let's now determine why the markets will move up in the first place. So the daily POI here marked out again at the price point of 39,718. This here is a daily POI that does give a large indication for higher prices. But again, what do we have over here? We have 4-hour POIs as well, right? We have 4-hour supply zones over here. So we're currently reacting off one now. I don't think this POI is going to hold, time of recording 8th of May, 2024. So this is a bearish POI again, bearish imbalance. Notice how we have one above as well. So we have a bearish imbalance above us as well, just like this. So we have two bearish imbalances on the 4-hour time frame in line with the daily POI. These are reasons for higher prices, and this is one of the IPTA driving factors, right? So IPDA, again, we're going to keep referring to this throughout the video. IPTA will move up to seek fair value gaps. So when you go on the markets, you want to ask yourself, where are the fair value gaps? Use the daily time frame and the 4-hour time frame, as these are the two driving indicators. I have a lot of students who use the 1-hour time frame. They get muddled up with the 50-minute time frame. They use maybe the 5-minute or the 10-minute. They keep skipping time frames and they don't develop a systematic plan and a systematic edge to employ in the markets. I'm teaching you how to do that using the basics of ICT. So we have a fair value gap over here. We have a fair value gap over here, and we have a daily fair value gap over here. Now, for those who were paying attention early on, I said that there were two main driving factors, two higher prices and lower prices. The first was fair value gaps. The second is liquidity. So when we have a supply zone here, and we have a supply zone here, and we have a supply zone here, what we have essentially is we have a large pool of liquidity that forms. Okay, so this red line over here, notice how we swept buy side liquidity over here. Now we target sell side liquidity. So we have fair value gaps and we have sell side liquidity to also target as well. So this red line represents sell side liquidity. And of course, IPTA will target two things, right? IPTA will target fair value gaps and sell side liquidity. And this is exactly why the overall bias on the Dow Jones is bullish, right? So I do think that these fair value gaps and this sell side liquidity will be targeted. Now, a couple of things to bear in mind is that before we get there, we could have price breaking structure giving us somewhat of a retracement before heading higher. So this is another thing to bring into people's attentions. The markets won't move up in a straight line. But again, why are the markets going to head down? Why is the market going to head down in this region over here? Well, look, we have a fair value gap over here. We have an inefficiency. So it's important to understand where the inefficiencies actually occur and understand that the markets themselves are likely to fill inefficiencies before heading higher. And we're going to be targeting higher inefficiencies that have been left over here, and over here. And these simultaneously leave buy-side liquidity in the process. So the overall purpose of the market for moving up or down in the first place is simply to sweep liquidity, buy side and sell side, and it's to target areas of inefficiencies, i.e. fair value gaps. So with these two things in mind, take this to your charts and apply it to everywhere that you think is fit.